Hello, everyone. My name is Joseph Manastra. I'm a first-year MHA student and a current PGY1 Health System Pharmacy Administration and Leadership resident at WVU Medicine, WVU Hospitals. And today I will be presenting on the balance sheet I submitted for my assignment last week for our health finance course, which was the McKesson 2024 fourth quarter and full year results. So looking at the company as a whole, of course, the name is McKesson. Its headquarters are located in Irving, Texas, but it does have numerous distribution centers and offices located throughout the United States, Canada, Ireland, England, Luxembourg, and China. The type of organization is that it is a pharmaceutical distributor, and it's a rather large one at that, which being a Fortune 500 company in the United States, specializing in pharmaceutical distribution, medical supplies, and health information technology services. And as mentioned in my title slide, this report is from 2024. So first, taking a look at the overall structure of the report itself, McKesson starts by breaking down the 2024 fourth quarter and full year, giving highlights, which are essentially just key takeaways, allowing for a quick assessment of the financial performance in 5 minutes or less of McKesson. McKesson then gives an outlook on the 2025 fiscal year, summarizing the expected financial growth over the next year, which is super important for both leaders within the institution and investors outside of it. Next, it gives a more detailed breakdown of the 2024 results, reporting financial outcome data from the 2024 fourth quarter and calendar year. And then it gives a breakdown of its various branches, giving summarized financial data from McKesson's pharmaceutical, prescription technology, medical surgical solutions, and international segments. Then McKesson reports out the consolidated statements, which include some that follow generally accepted accounting principles. There's non-GAAP statements, balance sheet statements, and cash flow statements. And then lastly, McKesson finishes it up by including some supplemental information, which is pretty commonplace for most companies. However, the content does vary based on the year. But in general, this is just additional information to augment the data presented throughout the rest of the report for whatever a company may be doing it. But now looking at the content itself. So first looking at the fourth quarter and full year highlights, McKesson reported that they had an 11% consolidated revenue increase in the fourth quarter to a total of $76.4 million and a 12% consolidated revenue increase across 2024 to a total of $309 million. So by these numbers, it's clear that McKesson had a successful year. Then McKesson gives their outlook for the 2025 year, and they are forecasting that their adjusted earnings per diluted share should increase from anywhere between 14 to 17% compared to 2024 in 2025. So giving a very positive outlook for both leaders and investors alike. And then it gives a fourth quarter and full year result summary. This is pretty self-explanatory, but in general, you can see at the top, you can see fourth quarter and full year, and then under each heading, you can see the FY24, FY23, and then change. So it's looking at 2024 compared to 2023, and then looking at the actual percentage change. So next, before I get into the consolidated statements, I just wanted to summarize these terms real quick. So GAAP, as we mentioned, is a standardized approach to reporting and interpreting financials for use by investors, leaders, and creditors. These reports typically are very accurate depictions of both positive and negative assets with no data manipulation to hide deficit. While non-GAAP statements are going to add supplemental information to augment GAAP statements using metrics that are not calculated by GAAPs. So this can kind of be thought of as a company excluding certain things like one-time payments or unexpected charges that are likely not to occur again. So in essence, it inflates their numbers a little bit, but does give a pretty true depiction of what the company would look like if those one-time charges had not had to be made. Then we have balance sheet statements, which we should be familiar with at this point, but in general, it's just a financial snapshot of a specific point in time, looking at assets, liabilities, and equity. And then lastly, we have a cash flow statement, which is just a summarized statement of a company's cash inflows and outflows. Here we have actual screen grabs from the report itself. So on the left, we have a GAAP statement, and on the right, we have a non-GAAP statement. So the GAAP statement is going to be looking at revenue and earnings per adjusted share. And then on the right, the non-GAAP statement, you're looking at adjusted earnings. So likely it's going to be excluding some of those one-time charges. It's going to make the numbers look a little bit better, but it is useful from both an internal and external perspective. Next, we have our balance sheet, which is located on the left, and the statement of cash flows, which is located on the right. The balance sheet we should be pretty familiar with, but I'll further break it down here in a moment when I calculate the net assets. But in general, the balance sheet, you can see at the top you have assets, in the middle you have liabilities and deficit, and then at the bottom, you've got some equity numbers there. And then on the right, you have a statement of cash flow. In this example, McKesson is giving a detailed report of how they're using monies in various sections. So looking at their operating activities, investing activities, and overall financing activities. So it's nice for investors and leaders to see actually how the company is using its money so that they can make adjustments for the next calendar year. So as I mentioned, I would give a further breakdown of the balance sheet to calculate the net assets. Starting up here on the left, you have a close-up screen grab of the assets. This one is very easy to calculate as the report actually does it itself. So you can see the very bottom line where it says total assets and a value. So this is $67,443,000, which explains why the total assets is what it is there at the top. And then on the right, you have total liabilities, which does get a little bit more complex as it's not as clear as one would think. So at the very bottom of this report, you can see total deficit, and then you can see another line that says total liabilities and deficit. To determine the total liabilities, you actually have to sum up these two numbers, as the total liabilities and deficit will always equal what the assets are. So adding a total asset will give you or total deficit will give you a different value. So summarizing the total deficit of $1,599,000 with the total liabilities and deficit of $67,443,000, you get a grand total liability of $69,042,000. Now, looking at the bottom left box here, the equation for calculating net assets is total assets minus the total liabilities and deficits, or just total liabilities. So the net assets, which is equal to $67,443,000 minus $69,042,000, which gives us a grand net asset of $1,599,000, which is a negative value, but it does make sense as assets are not liquid value, so it doesn't necessarily tie into revenue per se. So looking at this, you can see that while the company does have a lot of liabilities, they also do have a lot of assets as well. Next, I just real quick wanted to compare the McKesson balance sheet to the Sunnyvale Clinic balance sheet. In general, they are very similar, and I'll give a further breakdown here on the next slide. But you can see in general, the structure of them are very similar, with assets at the top and then liabilities and equity, towards the bottom of the page. But to give a specific breakdown here, I've got key similarities, key differences in the overall structure broken down here. So looking at assets, which is cash and cash equivalents, net receivables and inventories, property and equipment. These are common in both reports. And then liabilities both include current liabilities and long-term debt. However, the key differences for the assets and liabilities, it kind of breaks down to that McKesson is a larger company, is going to report out different values. And probably in a little bit more of a detailed manner. Some of the different assets that McKesson has, which is lease of right use, which is essentially when you are renting a property, the property gives you consent to use that property's value as an asset for the term of your lease. Goodwill, which is investment into other companies, essentially. And then intangibles are, I couldn't tell you what McKesson's specific intangibles are, but it's just another asset that they're reporting out. And then similar to the assets, McKesson's liabilities are reported in a little bit more of a detailed manner. Some of these include taxes, operating leases, and litigation, which McKesson is going to have various legal battles that they're facing on an annual basis. So that is something to consider when you're looking at their liabilities. However, the overall structure of these reports is very similar. The core elements are similar in content and organization. Both are structured very comparatively from top to bottom. However, McKesson's balance sheet just has some additional deficits, which adds on to it a little bit. So to conclude, McKesson is a very large pharmaceutical company, and Sunnyvale is a very small outpatient healthcare office. Despite these differences, the respective balance sheets are very similar in structure and the elements included. And lastly, the key to calculating net assets is correctly being able to summarize both total assets and liabilities. These are my references, and I appreciate you guys listening along. Thanks.